Hello traders. The title of the video is Uncovering Secrets of Second Elliott Wave Fibonacci Trading. Let's get started. All right. Previously, I have recorded a video that we titled Mastering Second Elliott Wave Fibonacci Trading Tactics Like a Pro. If you have not yet watched that video, please do so you may understand what we are about to discuss today. Because in that video, I was talking about the theory, the Elliott wave theory relating to, all right, second Elliott wave Fibonacci trading. All right, so watch it first. It's like 2 minutes only. Watch it very fast, and then come and watch this one. All right, let's get started. All right, so we are looking at the Dow Jones. All right. And we can use the second Elliott wave, talking about the structure of the second wave, the shape of the second wave, all right, the size of the second wave, to forecast the subsequent, all right, corrective wave. So after the second wave, the next corrective wave is what? The fourth Elliott wave. After the fourth Elliott wave, what is the next corrective wave? Is the corrective phase after the multi-wave itself, yes or no? Not only that, we can use the second Elliott wave to forecast the corrective wave of a higher degree. Because when we count 1, 2, 3, 4, 5 waves, we'll call it 1, and then that will become a wave of a higher degree. So the structure, the shape, the size, the depth, the width of the second wave can help us to forecast the subsequent corrective wave, even the higher degree corrective wave. So we're going to use today the Dow Jones Index. Right. So I want to clarify something very fast because I understand traders very well. And my view about all stock indices when I'm recording this video today is that all stock indices are in the fourth Elliott wave, and we are expecting the fifth wave. That's my general view. Same thing for Nasdaq 100. The fourth wave, we are now going into the fifth wave. That fourth wave, we put a question mark on it. When we are in a corrective wave, it's very, very important that we use a P42 draw channel because it's quite challenging to trade during the corrective phase. Therefore, one must draw trend line, channel, use P42, and most importantly, look for trading setup on the edge of key levels, and then one will implement a different time frame trading method. This is just in a bracket very fast for traders, so they may know where we are, fourth wave, heading to the fifth wave. Are we, that fourth wave, we put a question mark on it, going one step at a time, waiting for the price to confirm, okay, our expectation, all right? All right. So when we are looking at the Dow Jones, I'm on the monthly chart as usual, looking at the second wave, look, this is the second wave here, 1, 2, 3. What kind of second wave we are talking about here? All right. So when we are talking about the shape of the second wave, we are talking about the Elliott wave pattern. So when I ask you what is the shape of this second wave, I'm asking indirectly which Elliott wave pattern it is. This is a flat correction. Do you agree or disagree? Flat correction. You can see that the multi-wave, or this is supposed to be first wave, all right? When we apply, this is it, when we apply Fibonacci extension to the last segment of that multi-wave, so we started here, blah, 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 blah. This is the last segment. All right, we apply Fibonacci extension to that. You can see that the black line here is the 138.0% Fibonacci extension level of that. So we have what we call an expanded flat correction here. In fact, the price went up to the 161.8% Fibonacci extension level of the last segment of that multi-wave or that first wave session here. You want me to tell you? So if you want to put it on a chart, from the low of October 1998, all right, to the high of January 2000. If you do that, to bring you here, all right, at the level of 13263. So talking about the shape of the correct or the second wave, we have what? The Elliott wave pattern that we call the expanded flat correction. Right here, this is the flat correction. So when we are using the second wave to forecast the subsequent corrective wave, we are looking at the shape of it, talking about the corrective wave. So because you see the second wave for the Dow Jones is a flat correction, we can forecast. When I'm using the word forecast, we can expect. Now, for new traders, I want to speak to new traders. The expectation does not mean that definitely this is what's going to happen, but there is a high chance it may happen. So you need to wait. If the price is shaping it, so to speak, as an expanded flat correction, you have an edge. That's all right? It's not an exact science, okay? Because the shape of this second wave is a flat correction, right? The first corrective wave, the first subsequent corrective wave is what? It's the fourth wave. So that's why a trader was telling me, this was a question in the comment section. A trader was saying, George, for the Dow Jones, do we have a flat correction? That was an excellent question. Probably that trader was looking at the shape of the second wave here and knew that we can use the shape of the second wave to forecast the fourth wave. So that trader is saying to me, George, are we going to have a flat correction here? And I was saying to that trader, I personally, okay, I don't believe so. Doesn't mean that because I do not believe it cannot happen. It is possible, which will be very, very, very strange for me because we don't usually see a flat correction during the fourth wave. That's all. I don't expect a flat correction. But somebody looking at the shape of the second wave, which a lot of Elliott wave traders are thinking of, you can see that this one tried to go above the high of the third wave. So those traders are thinking of a flat correction. Again, even now we are going above the third wave. That's why I say this is it. The last, you see this last segment of the third wave, this one. So I can give you now from the low of April 2017, all right, to the high of January 2018. Apply Fibonacci extension to that, all right, and I highlight the 138.2% level. Okay, so if it's going to duplicate or mimic this flat correction, you want to watch that level. Another thing that you want to highlight is the 161.8% Fibonacci extension level of the last segment of that supposed to be third wave, which I already mentioned to you. Why do you need to watch the 161.8% level? Again here, see here, this one, the last segment of the first wave went above the 138.0 and touched okay, the 161.8% level. So if you are using the structure or the shape, talking about the shape of this second wave to have a bit of idea what can happen during the fourth wave, I'm not saying that that fourth wave is going to be a flat correction. I'm just saying that we can be prepared for a flat correction. But personally, talking about George, myself, I am not expecting a flat correction. I'm expecting a fifth wave. But it is possible that, behold, we may see a flat correction, which will be very strange for me personally. Are you getting it? If you have any question, please put in the comment section. Especially if you are a new trader, don't be afraid. Ask questions. Don't think that, oh, I may sound stupid, I may sound novice. No, just ask the question. You don't have to answer to anybody. Just ask the question. Whatever somebody is thinking of it is their problem. Just ask your question, it's your question, and I will get back to you. Okay? Right. So that's it. So the shape of the second wave can help us to forecast the subsequent corrective wave. Okay. So when we are talking about the shape, we are talking about the Elliott wave pattern. The video is about uncovering the secret of the second Elliott wave Fibonacci trading. So you may say, how about the Fibonacci trading then? All right, so I've already mentioned 138.2% and 161.8% level. Those are relating to the second Elliott wave. And then when we are talking about the fourth Elliott wave, that if it happened to be a flat correction, one must watch what? 138.2% and the 168.2, 168, 161.8% Fibonacci extension level of the last segment of the third wave. Okay, so we talk about last segment, this one here, okay? I better highlight it on my chart so I don't forget, okay, from here to here, okay? That's the last segment of the third wave. Highlight the 138.2%, 161.8% level. Don't assume anything. Don't think that definitely this was going to happen. You just need to watch those levels, okay? So the next thing about the second Elliott wave is about the size of the second wave. So when we are talking about the size of the second wave, right, to help us to forecast the subsequent corrective wave, which I've already mentioned, we are talking about the Fibonacci retracement, the depth of the second wave. So if you compare this second wave, which is a flat correction, how much retracement is that second wave in relation to the first wave? So it's almost 38.2%. It's a very shallow because you can see here that it was a very huge first wave and it just hanging here. It's a flat correction. Apologies trader for the noise. Okay, so though the expanded flat correction is a kind of a deep flat correction, but the depth, all right, DEPTH, depth of that second wave is 38.2% Fibonacci retracement of this huge first wave. So we are talking about Fibonacci extension. We are also talking about Fibonacci retracement of that second wave. Talking about okay, second Elliott wave Fibonacci trading. So you want to pay attention to the Fibonacci extensions of that second wave and also the Fibonacci retracement of that second wave in relation to the first wave. But very, very important, I want to mention to you, if you can see, this is very important, if you can see the last segment of the first wave, apply the Fibonacci extension only to the last segment of the first wave. I don't want to explain it to you. You can put a question there. You can say why. Ask a direct question, and I will come back to you. Okay? Normally, if you cannot see the last segment of the first wave, then you have to apply the Fibonacci extension to the whole first wave. As you can see, I don't want to speculate, meaning that because I can't see the beginning of that first wave clearly here, so I don't want to speculate. That's why most of the time, the last segment of the first wave will be very useful to us to determine the 138.2% and the 161.8% Fibonacci extension level of that last segment. Now, I'm dwelling on it because I don't want you to forget. That's it. You may say, Joe, move on, please. But I'm doing it on purpose, all right? So you do not forget because you can easily forget that, okay? So because this one went to 161.8% and 138.2% level, the same level we must be watching for the last segment of our third wave right here. Okay, very important. Now talking about the size of the second wave, we are talking about the depth and the width. Right? So first, the shape, when we are talking about the shape of the second wave, we are talking about the Elliott wave pattern. Okay, so you want to, it's an expanded flat correction. Okay, so we can focus that the fourth wave can be a flat correction, an expanded flat correction. We can focus that if the fifth wave is completed and the Dow Jones started a correction, that correction can be an expanded flat correction because of what we see here in the second wave. Are you getting it now? And you can say that because this expanded flat correction is only 38.2% retracement of the first wave, the fourth wave can also be 38.2% Fibonacci retracement level, forecast, expectation, not guarantee, not exact science. Are you getting it now? You want to speak like a professional Elliott wave analyst, right? Because they are very careful, right? So you see here, this is a shallow correction here. Now we put a question mark on it because it's, it's still not yet out of the wood, right? So it's still hanging there. It's going to form a flat correction. It's going to form the fifth wave. We put a question mark on it, all right? Right? You see, I'm going to talk about the S&P 500, and we'll be talking about the Nasdaq 100. So watch the full length for this video, okay? So remember when we are talking about the size, we are talking about the depth and the width. So why do we talk about the width? The width is the duration, how long it took for the second wave. This is also very important. You can see this one took from 2000 to 2008. That's 9 years. So we can say that we can also forecast because of the width of this second wave. There's a possibility that the fourth wave may also be prolonged. It can be prolonged, but we have alternance between the second and the fourth wave. I know some idiot will trader will say, George, I'm glad that you mentioned that because they will say if the second wave is extended, talking about the duration, the fourth wave will be swift. Probably that's why it was swift here. This is alternance between the fourth and the second wave. If the second wave is swift, the fourth wave is likely to be extended. This is just an expectation. This is just a forecast. It's not guaranteed. Anything is possible. We are flowing with the price. We don't want to be the purest idiot with traders imposing the idiot with theory to other traders. All right? Okay? So here it is. So because apart from the alternance, right? You want me to write the alternance? Are you getting what I'm saying? A lot of traders already understand what I'm speaking, but that's it. Alternance between the second and the fourth wave. All right? We mentioned that. But let's leave that one aside, okay? You want to remember also that there is a possibility that because we are using the second wave to forecast the subsequent corrective wave, we don't want to forget that it's normal that we mention also that the fourth wave can also be extended, talking about the same duration. It can, though we already mentioned the alternance between the second and the fourth wave. Again, with the width of the second wave, talking about the duration, we can forecast that if the fifth wave is completed and a correction has started, that correction can take up to 9 years. Doesn't mean that definitely it's going to take 9 years, but we are aware of it. As an Elliott trader, it's good to know before it happens. And if it's happening, you are not surprised. So if you are saying that the corrective wave can be prolonged, possible. It's not guaranteed. It can take 9 years maximum. That correction can be complex. We can have a WSY wave. So you see first a zigzag, and then you say, oh, John was saying that it may be extended. Where is it? It's a zigzag. And then you see, oh, X wave. Okay, and then you see a triangle, which is the Y wave. Now you combine the zigzag, the X, and the Y. And you see, oh, it's 9 years exactly as we have forecast. In that case, what we are talking about is a confirmation of our Elliott wave forecast. The price does not have to confirm every Elliott wave forecast. The good news is that you know something that a lot of technical traders do not know because you are an Elliott wave trader. Okay, which is good. It's always good to be prepared. In French, they say that a person that is one is equal to two. All right, un homme averti vaut deux. Because you already been warned. You know something that other traders do not know. So you prepare yourself for it. It does not mean that you go ahead of the price. You just flow with the price. So for instance here, if you see a flat correction happening, we say, well, this is a very old fourth wave. Normally we don't see a flat correction in the fourth wave. And then we look at the second wave, we say, well, this is it. We knew that it is possible. Or if the fifth wave is completed, and then we see flat correction, we say, well, we were expecting that. Okay? Or if we see the correction that is prolonged, that takes more than 8 years and 9 years, we are aware of it. We know before it's happening. Okay? Those are the things you need to pay attention to. Or after the fifth wave, because you see, this is the second wave, it went above the high of the first wave. So we can expect if an expanded flat correction is going to be formed after we have labeled the fifth wave, all right? After we have labeled the fifth wave, we need to apply, okay, the Fibonacci extension to that fifth wave and highlight again 138.2% and the 161.8% level, yes or no? Because if an expanded flat correction, it will be formed at the end of the multi-wave, at the end of the fifth wave, that expanded flat correction will go to the 138.2%, even touching the 161.8% Fibonacci extension level of the fifth wave. And people will be saying that, oh, people were saying that the market is going to crash, that the trend has ended at the end of the fifth wave. Why is it going above the fifth wave? And then you will understand that probably we're going to have a flat correction. The mistake that you do not want to make, all right, is to start selling and doing things because you know it before it's happening. So there is a danger for somebody who knows something to rush. You don't want to rush. You want to be very patient. Use the, see here, almost you see this one? It went up to that level. So you can be very patient. This is what we are saying. Now, if break below the common settler and retest it here, you see, break below, retest. You want to stay very calm. Okay, this is what you're saying. The same thing I was speaking to traders that have used our Elliott wave forecast. Right? So in the forecast, I may record a 10-minute video or 15-minute video. All right? I'm not talking to one trader alone. I'm talking to all traders who did use our Elliott wave forecast. Okay. So I will record 15-minute video. I will mention everything to you. I may say prior to bullish signal above, prior to bearish signal below, fourth wave, fifth wave, and so on. Before you will get paid, all right, using that Elliott wave forecast, you must find a trading setup and apply a top-down trading method to trade it. That one, I cannot do it for you. I cannot do it for you. This is it. Okay. So here it is. So with the shape, the size of the second wave, looking at the Fibonacci extension and the Fibonacci retracement of the second wave, we can forecast the subsequent corrective wave. The first corrective wave after the second wave is what? The fourth wave. The next one is what? The corrective phase after the multi-wave. The next one is what? The other corrective wave of a higher degree or during that are formed during another impulse wave. For instance, if we are during, we see for instance a third wave of a higher degree being formed that is subdivided in 5 minor waves. Third wave of a higher degree subdivided into 5 minor waves. So with the shape of the original or the initial second wave, we can forecast again the second minor wave of that third wave of a higher degree, and also the fourth minor wave of that third wave of a higher degree. It's a pattern that it is in place. And we can keep it, we can store it. It's a genetical information if we are allowed to use that word as an Elliott wave trader. So you see now? So this is what, so normally the teaching that they tell people is that one can use the second way to forecast the corrective way after the multi-wave. I recommend to traders to use it also for the fourth wave, not only for the fourth wave, for the corrective phase, for any subsequent corrective wave. You can quote me on Twitter and Facebook anywhere because why? Understand the fractal pattern. In fact, I will be talking also about how can we use the fourth wave to forecast the next corrective wave. You see, so any corrective wave that happens first, we can use those corrective waves to look at them, the shape, the size, talking about Fibonacci extension, Fibonacci resistance on those corrective waves, if they have happened before. So we can use those corrective waves that have already taken place as our leading tool to determine what is likely to happen in the future. That's all. Am I speaking too much? Or am I using my Bangalore accent today? Okay. Are you getting the message? So now I'm going to use another. So we talk about the shape that we are referring to the Elliott wave pattern. We're talking about the size. The size, we are talking about the depth, Fibonacci retracement, right? And also the width, the duration of the second wave. Now I'm going to use another way. I want you to pay attention to that. The structure of the second wave. So when we are talking about the structure of the second wave, we are referring to the internal wave of the second wave. How do they connect? So for the flat correction, we'll say 1. So 1, it's not very clear, it's a messy one here. 1, 2, 3. All right. So see then we will say 1, 2, 3. And then we say 1, 2, 3, 4, 5. You see, it's not very clear. If it's not very clear, there's nothing you're going to do about it. But we know the internal way of the flat correction. So the structure of the second way will also help us to determine, to forecast the structure of the subsequent corrective wave. So if you are having difficulties to understand my academic English, I'm going to write it for subsequent. Okay, hold on, please. That's the word I'm using. All right, so subsequent. That's it. All right, following. All right, subsequent. That's it. Okay, corrective wave. You can Google. If you don't understand, well, just go on Google. Right? Google is a powerful tool. Just go, what is the meaning of subsequent? You say, oh, George, I don't understand alternate. Just go on Google. What is alternance? All right? Powerful tool. Yeah. It's not only for search. You can ask Google questions. It will answer you. All right? So let's move on, please. So the structure is the internal. So now you may say, Joe, what Fibonacci got to do with the structure of the second way? Did you answer that question? You unbelieve boy. I don't believe girl, because 9% of our viewers are now women, so I need to talk about ladies also now. So we are talking about the internal wave. Now, the internal wave, they also have Fibonacci retracement and Fibonacci extension. Is it too much for you? Too much information? Right? I need to tell you, right? So when you are ready, you can start using it. It's like somebody give you all kind of tool to use today. And you say, George, I don't want to use them all. I say, you will need it. You will need it one day. All right. So all you do, you store it. You keep it in a safe place. All right. And you can come back to it. But as a beginner, you start using one tool at a time. That's it. So George is too much. Okay. You take one. Play with that on your demo account until you master it. And then you take another one. And then you take another one. Okay. That's it. So when we are talking about the structure, we are talking about the internal waves. And the internal wave, we want to watch the Fibonacci retracement and the Fibonacci extension from one internal wave to another internal wave. For instance, here, one thing we can do is, for instance, here, for the Dow Jones, you see the first leg, 1, 2, you can see how, okay, the second one, this one, retraces this move down. So you apply Fibonacci retracement from the here to here. That's the first part of the A part of the flat correction. And then you want to know how far this one went up. So the retracement is this stop at 50%. So roughly stop at 50% Fibonacci retracement level. So if, I'm choosing my word very carefully, if we are having a flat correction during a corrective fell, and we see the first leg and it start bouncing now, we will be watching the 50% Fibonacci retracement of that first leg of the A part of the flat correction if we're going to have a flat correction. So the same thing, you see this move up, 1, 2. How much retracement was this move down? You want to watch it. So we are looking at the structure of the second wave, talking about the internal wave, and we are measuring the Fibonacci extension and retracement of those internal waves in comparison to each other. Now, I can dwell on that, I can record a video on that, but I'm giving it to you now. But because we don't want the video to be too long, just understand it that way. Take it, all right? Take the core value, take it as I give it to you. The shape, in your wave pattern, the size, the depth, and the width. Right? Width means duration. Okay. Now we are talking about the structure. If it's too much for you to understand the internal wave, understand the internal wave in relation to Fibonacci extension and retracement. We want to use that, copy that, and compare it to the next corrective wave and see whether the corrective wave that is taking place in the future is duplicating or mimicking the past corrective waves, especially the second Elliott wave. All right. So we can, as I mentioned to you before, we can use the second wave to forecast the fourth wave, the corrective phase after the multi-wave, and the subsequent corrective wave, including the higher degree corrective wave. All right. Now, one more thing that I want to recommend to traders, which are not taught in the classroom of Elliott wave, generally speaking, is this. So you see this corrective wave here, all right? Second wave, all right? Corrective wave. Now, if for instance, suppose you are on the 4-hour time frame, it's very important point. 4-hour time frame, and you see a second wave that have been formed, and you apply this strategy. You say, all right, the shape, all right, the size, and the structure. Right? You apply that. Okay. What you need to do is to go back in time on the same time frame and see whether there were other second Elliott wave before. If in the past you had other second wave on that time frame, all right, you want to pay attention to those second wave and compare the current second wave to the past second wave. Why? The reason is some stock, right, will be, for instance, a stock may be exhibiting a flat correction in the second wave most of the time, or a zigzag in the second wave all the time, or a specific Elliott wave pattern. That stock will be doing year after year. So that's why I also recommend to traders to compare the current second wave to the past second wave to see whether there was a pattern that is happening. So, for instance, you see, I'm on a monthly chart, I see a flat correction for Dow Jones. If I have enough data to go back into the past and see another second wave, and that will give me a bit of idea. I'll say, well, the Dow Jones is likely to exhibit second wave as a flat correction quite often. So this is something we need to be aware of, knowing that the Dow Jones quite often will exhibit a flat correction instead of a zigzag. So all I'm saying to you, one can check past a second wave, especially on time frames higher or equal to the monthly chart. So I'm using the example of the 4-hour time frame because on the monthly chart here, I don't have another second wave. That's why I'm talking about the 4-hour time frame. So if you're reaching on the daily, the hourly time frame, you see one second wave. You can go back in time if you have enough data to see other second wave. You may notice that a particular wave pattern is often being formed in the second wave. Why is it telling you? It's telling you that those market participants that are trading that stock are doing almost the same thing. They are living a pattern. They are living a pattern. Is it too much? So I promise you that I will be talking about, okay, the next 100, yes or no? So let's bring on now the next 100, and we're going to talk about the second wave or the next 100. So you can see that for the Dow Jones, we have an expanded flat correction. Look at this. For the next 100, the second wave is what? A zigzag. So this is about what? The shape of the second wave is a zigzag. So for the next 100, the Elliott wave analyst will say, at the end of the fifth wave, the corrective wave that we'll be expecting, the first one will be a zigzag pattern. Doesn't mean that definitely we're going to have a zigzag. That's the first thing coming to our mind. And we can also look in at the zigzag, that the A part of the zigzag was quite deep, you can see here. It came down to the what? We are talking about Fibonacci extension, Fibonacci retracement. It came down to the second sweet spot zone. So if you don't know what is the second sweet spot zone, it means that you are not watching our video in full at Day Pro Traders. The first sweet spot zone is what? Between the 50 and the 61.8% Fibonacci retracement level. And the second sweet spot zone is between the 78 and the 88.6% Fibonacci retracement level. So you can see this is the first wave of the Nasdaq 100, and the A part of that zigzag brought the price into the second sweet spot zone, very deep. So with the shape of this zigzag here, we can forecast that there is a high chance, not guaranteed, all right? We can expect that the A part of that zigzag may be quite deep, can be sharp move down, all right? This is it. This is the shape, the zigzag pattern. Yes or no? Now, if we are talking about the size of this second wave, we'll be talking about the width, yes or no. The width means how long it took. It also took 9 years almost. So the same thing we will be forecasting. I don't want to repeat myself like we did for the Dow Jones. We'll be doing the same thing, talking about the width or the size of the second wave. If you are talking about the depth, it's very deep second wave, bringing the price to the zone between the 78 and the 88.6% level. So if we compare the Nasdaq 100 to the Dow Jones had a shallow correction during the second wave, while the Nasdaq 100 had a very deep correction. The reason was, I understand, where you bought that time, because of the technology bubble. They were overbought, and people were selling the technology like a mad dog. They don't want to know anymore. That's why we have a deep retracement for the technology stock. Once you want to understand that this technology stock, if you are bearish trader, if the technology stock are bearish, you should be selling them because they will go down very fast, faster than the component of the Nasdaq 100. The technology stock can go up fast and can go down very fast. This is just a characteristic of the technology stock, okay? Because they come out with a technology, everybody jump up, iPhone, the runner price went up very fast. And then the next thing, there's something bad happened, everybody ran away from that technology, embracing a new technology. So here we have a zigzag pattern. It took almost 9 years. It's a very deep retracement, 78.6% Fibonacci retracement level. Now, you want to apply again the Fibonacci retracement to this session to see how far this one went up. Now we are talking about the structure of the second wave. How, okay, the B wave of the zigzag retraces the A wave of the zigzag. It looks to me like 38.2%, something like that. Below 50%, okay, below 50%. It didn't touch the 50%. Yeah, it didn't touch it. So something like that. Are you getting it now? All right. So you want to, the same thing we have done for the Dow Jones, we'll do the same thing here to forecast the fourth wave, the corrective phase, and the subsequent corrective wave, including the higher degree in your wave. Again, when we go deeper about the corrective wave, about the structure of the second wave, we now go step by step the internal wave of this zigzag. Zigzag is 1, 2, 3, 4, 5. Right now, you want to see how the second minor wave of the A wave retraces the first one, and so on. Talking about Fibonacci retracement and the Fibonacci extension. You see this one coming down. The extension of this one, how far it went down in relation to the extension of this one, you see. You'll be using the Fibonacci retracement and the Fibonacci extension to compare the internal waves of each segment of the second wave that will help you to be prepared for the same scenario if it is happening, to give you heads up, so to speak, so you may be prepared. All right? So one example will be like now, suppose we are at the end of the fifth wave here, all right? And then we see this move down like this. All right, this one start going up. You quickly, you apply Fibonacci, so you go like this. This is not to say that this is exactly what's going to happen. You see, all right, that's 61.8% retracement. This one went up 61.8% Fibonacci retracement level. So you will draw a line there and you'll be monitoring the reaction of the price there. If there is a trading setup to sell there, you will be selling. And you will be watching after that. If it start going down, you apply Fibonacci extension to this one, extension to this segment, and see how far this one went down. So those things, talking about Fibonacci extension of the internal wave, and Fibonacci retracement of the internal wave of the second wave, they can help us to forecast the fourth wave, the corrective phase, and the subsequent corrective wave, even during the higher degree corrections. You see it? Right? So for the Nasdaq 100, for traders that purchase the accurate in-your wave forecast, as always, I say to traders that we were in a fourth wave with a question mark on it. We are expecting a fifth wave. That's the key message. Now, in order to get paid, traders, so what are we watching now? is this a black pitchfork tool? This one. Try the pitchfork tool. We allow us to determine the possible path that the price will take. So you see, it went below the median line, so we are here. If you draw a trend line, this is it. This is a very, I'm going to draw it like this. You do the same thing on your chart, connecting this low here of December 2018, connected to this low of August 2019. Just leave it there. That trend line is very, very important trend line right now. All right. Now, apart from the trend line, right now, so we talk about this level 7677 was a resistance. Now the price goes above it. So again, I never say to trade a buy or sell because of what I've seen myself in the past before. Right? Is that I purchased a trading service when a trader said to me to buy, and I thought it was wrong. Better to say to traders to be ready to buy or to sell. How do you do that? You do it like this, like now. What can I say to somebody trading the Nasdaq 100? I'll say to that person, we are expecting a fifth wave. Now, our fourth wave has a question mark on it because of what we have seen in the second wave here. All right? So here it is. If the fifth wave will continue, it must break resistance. So that resistance that we are watching here, 7677, is taken out. At this junction, as I'm recording the video today, priority, this is it, priority to bullish signal above 7852 and priority to bearish signal below that. It means that you want to look for trading opportunity above and below that. So you will use a different time frame trading method. So the line that I draw on a monthly chart, see here. So on a daily chart, I'm now on a daily chart, it breaks above it, which is good. It pulled back to retest it. Now, the market is not yet open. So if the market is open, they will be looking for an opportunity to buy above that level. They're not just going to buy like this. That will be wrong because it can come down more. So you need to go now to the hourly time frame. And any time you change time frame, you must draw channel. Here it is. We can draw this on the hourly time frame. And apart from the easier way that we have discussed already, in order to get paid, those are the things you need to work on. Right? So we have a channel on the hourly time frame. Where are we now? We are now at the bottom of that channel. So if you are buying a ball 7852, be aware of that trend line there. You're not going to enter the trend here on the hourly time frame, do you? You're going to go again, you see. So you don't want to violate the market. So now, somebody that is following us at the day for traders will automatically do something like this because they know market geometry. Right? This is it. Am I talking too much? All right. So all I'm saying, don't say that, Joe, you are patronizing me, Joe, you are talking to me. Never think that I'm talking to you, one person. Right? I talk to many traders because you'll be surprised. Normally, I should be, there were TST traders who asked me questions, right? Sometimes I keep them waiting when I'm posting video on YouTube. It's unfair. Those people pay me money, all right? They purchase a system. I should be spending my time for those. But sometimes I make them wait because of ordinary traders on YouTube. This is it. Yeah. All I'm doing, I'm trying to encourage traders. That's all. As you say, Joe, you are speaking a bit too much. I'm trying to encourage you. Moving at 100. Right? So this is it. You want to look for trading setup on the edge. If we drop down to the 10-minute time frame, again, anytime you change time frame, just draw your line. See, here it is. 10-minute time frame is stuck in a declining channel. Okay? Is it going to come out nicely, gently, and give us a bullish sharp pattern or a higher low, and the common central line is broken to allow us to enter the trade safely somewhere where we can place our stop loss. Understand that anytime you enter a trade, you need a bit of luck. This is something I say And sometimes they don't agree with me because you may do everything that you need to do, but you need that divine intervention. Are we allowed to use that word on you too? I think so, because there is always a bit of luck in the market. One can do everything they enter here, and then the next thing, down. Well, it happened, all right? That's it. All right, so here it is. So let's go back to our main topic. In your way, it's just in bracket, all right, to help trading and trading the Dow Jones. So we have a zigzag pattern. With that, looking at the shape, the size, and the structure, using Fibonacci extension and retracement of the second wave, we can forecast the subsequent corrective wave. If, as I promised to trader, if we quickly look at the S&P 500, hold on, please. Let's see how long I've been back into my phone, my headphone. Okay, 45 minutes. We went over our time. Apologies to traders. Let's continue. So here we are. What do we have here? This is we talking about the shape. Which Elliott wave pattern we have here for the second one? It's our second one. What's that? Is it a zigzag? No, it's not a zigzag. This is a classic flat correction. The expanded flat correction will go to the 138.2% level, even beyond that a little bit, as we have seen for the Dow Jones. But the classic one will not go above the high of the first wave or the high of the multi-wave. This is a classic flat correction. Again, this is about the shape of the second wave. So at the end of the fifth wave, trader will be thinking of the first thing that will come to their mind will be a classic flat correction. So they will also apply the Fibonacci retracement, you see here, for the whole first wave and see how much retracement is this one. So from the low all the way up here is 50% Fibonacci retracement. So this is about the size of the second wave of the S&P 500. So there's the depth of the corrective phase that they will be expecting will be 50% Fibonacci retracement level. Again, they will be paying attention to the structure of this second wave, talking about the internal wave, and also paying attention to the Fibonacci retracement extension of all those internal wave in view to predict what is likely to happen in the subsequent corrective wave, talking about the fourth, the corrective phase, and any other corrective wave that will happen in the future. Have I covered everything? So to summarize this video, all right, the general teaching about the Elliott wave is that one can use the second wave to forecast the corrective wave. This is what everybody is talking about. My recommendation is that why can't you pay attention to the second wave and use it also to forecast any corrective wave, including the fourth wave, even the internal corrective wave. For instance, the internal corrective wave of the third wave. Of any corrective wave. That's what I'm saying. That's my recommendation to this. Now, why am I saying that? Because I understand the fractal patterns. So, a corrective wave that has happened before, one must take note of it and pay attention to it, looking at the Fibonacci extension and retracement of it, talking about the shape, the size, and the structure of that corrective wave. Is a pattern. That pattern can help us to forecast the future corrective wave. That's what I'm saying. That's the exercise that we have done for the Dow Jones. So, but one thing that I want to bang on before we move on is that when you start doing that, okay, don't get carried away. Sometimes you will focus the market and the market will confirm it on the dot, 100%. So you say it's going to be a flat, you may say to people, you forecast it, you say it's going to be a classic flat correction, and the price will print it that out. You may say that the depth will be 50% and the price will print it exactly. You may forecast even the structure, the internal wave, the retracement and everything, the extension and everything, and the price will do exactly that. You may even go a little bit deeper, talking about the volatility during the last leg of the correction, saying that in the last portion of the correction, we are likely to see a high volatility. Because of what we have seen in the second wave, we can go deeper and we can talk about the duration, how long it will take. And sometimes the price will do exactly as you have forecast. Sometimes the price will deny it completely, which means the price may not confirm even one bit of your forecast. It doesn't mean that your forecast is wrong. Your forecast was correct, because of the rules of the Elliott wave, the price has printed something else out. In order to get paid with your forecast, which is an expectation, the price must confirm it. And when the price confirming it, what do? You look for a trading setup on the edge, and you must use a different time frame trading method to control the risk. Now, recently, a trader did ask me a question, a very important question. In fact, I need to answer that trader. That trader is TST trader. Here I am talking to traders that are not TST traders. You see, this is what we are talking about. Now, the question was about economy news, forex economy news. The economy news, the market sentiment, can change the dynamics of Elliott wave forecast. Recently, the market in August, the market was bearish. You see, so there are external factors. The Elliott wave forecast will not change the market sentiment and will not change the market environment or will not change the economy news. But they will help us to mitigate the economy news and to make excellent decisions. Sometimes you may be forecasting something and the economy news will help you because you're expecting the price to go down. Suppose you were here. All right, you forecasted that the last month will be volatile, and here they have some bad news coming to the market. That bad news is not working against your forecast, it's helping your forecast. Yes, it's coming up, boom, 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 boom. You see, I told you before, but why is it happening? Because there is a concurrence. You forecast it, and something happens, and helping your forecast. Sometimes the news or the market something may work against the forecast. What are you going to do about that? Nothing. The forecast remain intact. That's why I do not remove my line on my chart. A lot of Elliott wave traders sometimes they feel a bit ashamed. They say, "Oh, I don't want them to see that. I don't want them to feel like a lie." No, you are not lying to anybody. All right? You have made your forecast following the Elliott wave standard. Have you followed the standard? Yes. Okay, your job is done. Full stop. It's like a police officer being sent to investigate somebody. The role of the police officer is to stand and look if somebody is breaking the law. If no law is broken, the report will be, we have not seen anything, yes or no. The same thing we are doing as an Elliott wave trader that is focusing the market. We look at the S&P 500, that's what we can say. Passive flat correction, 50% Fibonacci retracement level, a tip up to 9 years, but the forecast is an expectation. And so on. The last segment of the correction can be volatile. Now, because it took 9 years, that correction can end up being WSY wave. If it's not a classic flat correction, it can even be any other correction wave. Now, the advantage, you have to understand what's going on, why people do care about the market prediction or market forecast. The reason is, it's not for ordinary traders, all right? It's for the hedge fund, those that are pumping a lot of money in the market. So you want to pump millions of dollars into the market, invest, and it makes sense to have to ask people who know a little bit about market forecast to tell you how the weather may be. You want to fly or you want to travel, you want to check the weather, yes or no, all right? So if a hurricane happens often in that place, you're not going to just jump on your plane and start going. You want to check first. The same thing the big investors are doing. They want a forecast. So when they provide them with a forecast, doesn't mean they just go and buy. It helps them to navigate. It helps them, okay, to go through the weather. So when they see things happening, they understand. They have been warned. So they are prepared. So what they are caring about is to be defensive and to make excellent decisions. So when you purchase Elliott wave forecast, right, I will be talking about that though, okay? We'll be talking about that. And I will tell traders the Elliott wave forecast, they can look at it. So what I want to do, I will be doing, I will tell traders at least 2 Elliott wave forecasts that I know about, all right? And I will tell them, they will go and use it. And they will come back and tell me how they find it. Okay? All right? I'll tell you on this channel, all right? You go and use it and come back. And then you can try mine also. And then you will tell me, what do you think? Okay. Now, what I'm saying is that it may not suit some traders, it may suit some traders. Now, talking about the way I talk to traders is different to the way other traders are discussing matters. I don't go and criticize those traders. I don't tell them, oh, we all should speak with the same accent like George. I don't. The point I'm making is, all right, there is an Elliott way theory, Elliott way principle, and we follow it. But I will not lie to traders and say to them, uh, I am the Elliott way guru. If you don't believe me, it's your own problem. The honest truth is that the Elliott way forecast is an expectation, and the price must confirm it. This is the end of this long tutorial, but it's very, very important tutorial. That's why we dwell on it. All right. I hope we have managed to uncover, okay, the secret of the second Elliott way Fibonacci trading that will help us to focus the market more accurately. All in all, when we look at the shape, the size, and the structure of the second way to focus the subsequent corrective way. What I did add to traders is that traders must use the second wave to focus even the fourth corrective phase and the subsequent corrective wave even during the higher degree waveform. Another thing that I did add was that check past second wave, especially on time frame higher or equal to the monthly chart. So you may watch this video, you start playing with it on the 5-minute time frame, hourly time frame, 4-hour time frame, but it's not as solid as it is on a monthly chart. That's what I want to say to trading. So sometimes new trader will learn something like this and will go on a lower time frame playing with it. Just be aware that sometimes it may be perfect, sometimes it may not. You work better on higher time frame. If this video has been truly, truly useful to you, please let us know by giving us the thumbs up. If you dislike it, don't go away, mark it down. If you think it's an essential tutorial, feel free to share with your friend on the social media. Okay. Subscribe to our YouTube channel. Our YouTube channel is 24 Elliott Wave. Digit 2, digit 4, Elliott Wave in plural. Be sure to click on the notification bell so anytime we record a new video, you will be the first person to be notified. All right. So if you think that the video is too long for you, you can break it down, watch 50 minutes, okay, and then go away. Come back another time, watch 50 minutes, okay. But don't watch it halfway, otherwise it's pointless. All right. If you're not going to watch it in full, it's pointless to even start watching it, all right, because it will damage, all right, our performance on YouTube, all right. So you may decide to watch 10 minutes, 6 times, all right, or 50 minutes, 4 times, or 30 minutes twice. All right, it's up to you in your own time. This is an essential tutorial. We can break it down. That's why we were analyzing the Dow Jones, the DAX 100, and the S&P 500. Another thing that I can add here for the Dow Jones, if you look carefully, you will see that the Dow Jones initially here, traders were expecting a zigzag pattern here. You can see it pulled back like this. People see that's the A part of the prior rally up to the 50% Fibonacci retracement level of this move down. People were trying here to push it down to form the zigzag pattern, but it escaped and went up more. That's what we are talking about. So here, probably a lot of people did forecast a zigzag pattern, right? But it formed an expanded flat correction. You see that the Dow Jones did not form a zigzag pattern, but the NASDAQ 100 did form a zigzag pattern, you see. Because one more thing I need to add to those that are using trading indices, we can use even the second wave of a NASDAQ 100 to focus the second wave or the corrective wave of another indices because they are indices. So apart from looking at the Dow Jones second wave alone, the more advanced Elliott wave trader will also use even the second wave of the NASDAQ 100 and the second wave of the S&P 500, meaning that I'm allowed as an Elliott wave practitioner to even warn market participants that though for the Dow Jones we are expecting an expanded flat correction as the first corrective wave, one can also expect a zigzag pattern because of the NASDAQ 100 and a classic flat correction because of the S&P 500 because they belong to the same group. Sometimes, if you are analyzing another stock, for instance, you are analyzing a stock that belongs to the Dow 30 index, all right? You are analyzing ExxonMobil, okay? You can look, for instance, at the structure of the second wave of McDonald's stock to predict what is likely to happen to ExxonMobil. Now, that's a different matter. I don't want you to get confused, all right? So until the next time, enjoy yourself and be very happy. We are the TSTWSYS008 traders talking about uncovering a secret of second Indian wave Fibonacci trading. Happy trading to you all, and thank you very much for watching.